Stackers stop for a moment and stare at the screen. Those red drops flashing back aren't just prices, they are pressure. They are rigged to trigger fear, doubt, and urgency all at once, trying to break your strong hands. I know that feeling hitting you, the tight chest, that nagging internal voice asking if you messed up, wondering if you should fold your hand and sell your stack now before the manipulation drags the spot price lower. Only 48 hours back, silver was kissing record highs. The vibe was pure euphoria. Triple-digit silver wasn't a dream. It was the plan. Now it's Monday, December 29th, and spot sits at $75. The chart is nasty. Momentum is dead, and the mainstream media is already spinning the narrative the bubble popped. The silver squeeze is finished. It's all over. Sell your stack before the crash. Just stop, breathe deep, listen close. Fundamentals haven't budged. No massive supply dump hit the market. No miner found a secret mountain of silver ore. No Fed policy flipped. The physical reality is exactly the same as it was 2 days back. The only shift is that paper price number on the screen. What you see isn't a collapse, it is a classic banker setup. This last week of the year isn't a real market. Liquidity vanishes. Volume dies down, the big players are on holiday. What's left is a ghost town run by algos and junior traders reacting to thin noise. In this void spot, prices don't move on fundamentals. They move simply because there is absolutely no resistance on the books. A single bear raid can look like a breakdown. A temporary air pocket can feel like the end of the story. That illusion exists for one reason only: to test your conviction now. This is where markets transfer wealth, not through intelligence, but through emotion. If you mistake illusion for reality, you hand over your position to smart money who understands the difference. This week has a specific name, and understanding it may change how you view everything that follows. Type number 1 to continue to chapter 2. Type number 2 to stop right here. If this changed how you read the charts, subscribe to the channel and comment the number 1 down below. Now that you've taken a breath, let's talk about why this moment feels so violent and why it was almost guaranteed to happen right now. Markets don't just move on numbers, they move on structure, and the structure of this particular week is fundamentally broken down. The days between Christmas and New Year's are what professionals quietly refer to as a dead zone. Volume collapses, order books thin out, liquidity evaporates. In a normal week, if someone wants to sell a large block of silver, there are layers of buyers waiting. The transaction gets absorbed. The price barely flinches. It's like tossing a stone into the deep ocean. But this week isn't the ocean, it is a tiny bathtub. When liquidity disappears, the market becomes fragile. One aggressive sell order doesn't meet resistance, it falls through empty space. Prices don't decline gradually, they drop vertically until they collide with the next technical level where someone somewhere is willing to step in. That sudden fall looks terrifying on a chart, but it's not a reflection of value. It's a reflection of total absence. And this is where human psychology enters the equation. A sharp red candle doesn't just move price, it sends a signal. Technical systems read it as failure. Momentum traders read it as weakness. Retail investors read it as danger. The market doesn't need bad news when it can manufacture fear through optics alone today. Ask yourself a simple question. If silver's fundamentals were truly broken, if the long-term thesis had collapsed, why would this move happen during the lowest volume week of the entire year? Why not during peak participation, when conviction could be tested honestly? Because this isn't about price discovery, it's about exploitation. Thin markets allow small actions to create exaggerated reactions, and exaggerated reactions force emotional decisions. This is not random volatility, it's predictable behavior in a distorted market environment. The chart isn't lying, but it's not telling the whole truth either. You're watching shadows move on the wall, not the source of the light. And if you don't understand the structure behind the movement, you'll misinterpret market noise as signal. Before you react, before you decide anything, you need to understand who benefits from this confusion and who really doesn't. To understand what's really happening, you have to stop thinking like a chart reader and start thinking like a poker player. This move to $75 isn't about silver, it's about you. More specifically, it's about your emotions, your leverage, and your pain threshold level. Large banks know exactly how retail positioning works. They know where late buyers entered 78.79 near the highs. They know how many traders are sitting on a margin. They know how many options expire this week. And most importantly, they know where the stop-loss orders are clustered. Those levels aren't a mystery. They're visible market footprints. In a thin market, triggering those stops costs almost nothing. A brief, aggressive push downward is enough to trip a chain reaction. Once the price hits, those levels selling becomes automatic. Computers sell, brokers liquidate, traders panic, and suddenly a manufactured drop feeds on itself fully. Here's the part most people miss: the selling you're seeing isn't voluntary, it's forced. It's margin calls, it's stop-loss executions, it's fear doing exactly what it was designed to do. And on the other side of every forced sale is a buyer who wanted your position all along today. This is called a liquidity flush. Shake the tree, see what falls out. Weak hands let go, not because they're wrong, but because they're uncomfortable. And discomfort is expensive in these markets. Ask yourself, who would benefit from silver being cheaper right now? Who would want to accumulate before a known structural change? It's not the small trader staring at a phone screen. It's the entities with time capital and patience, really. This is why these moves always feel personal. They're meant to. Doubt creeps in quietly. Maybe the thesis is wrong. Maybe the shortage isn't real. Maybe I should just protect what's left. That internal conversation is the real battlefield, truly. Markets don't punish ignorance, they punish emotional reactions. And moments like this are designed to separate those who react from those who observe well. If you're still focused only on the New York chart, you're missing the most important signal in the entire market right now. Because while one side of the world is being shaken out, the other side is doing something very different indeed. And that's where the whole story truly changes. While fear dominates one screen, discipline controls another. To see it, you have to stop staring at New York and look east. Because at the exact moment silver is being shaken out in the West, it's being pulled in with urgency in Asia today. In China, silver isn't a speculative storyline, it's an industrial lifeline. It runs through solar production, electronics, and energy infrastructure. Buyers there don't care about a red candle on a holiday chart. They care about securing metal-keeping factories running and protecting supply chains. And right now, they're willing to pay a premium to do it all. This is where the narrative fractures apart. Western traders are reacting to a $75 paper quote, but Chinese markets are trading a different reality, one that signals tightness, not the weakness. The gap between these two prices isn't a rounding error. It's wide, stubborn, and increasingly hard to explain away fully. In a functioning global market, that shouldn't happen. Arbitrage is supposed to erase differences fast. Buy cheap here, sell higher there, and the spread disappears. That mechanism is the glue that keeps global pricing honest. But today that glue is failing, and it's not because traders forgot the math. It's because something is blocking the flow here. When arbitrage breaks, it's not a curiosity. It's a huge warning. It tells you the market that actually needs silver is valuing it far more than the market that merely trades it. One price reflects physical necessity. The other reflects thin liquidity derivatives and ghost-weak psychology today. Two prices are forming for the same asset, one driven by fear, one driven by need. History is very clear about how this ends. When physical demand refuses to follow paper weakness, the paper price eventually snaps back to reality hard now. One side is shaking out, the other is accumulating. And the distance between those two actions is where the real opportunity hides truly. Now we need to confront the number that exposes the entire illusion, because once you do the math, the $75 price stops looking scary and starts looking absurd to us. While New York traders are staring at a falling chart, the Shanghai market is broadcasting a completely different signal. The front-month silver contract there is trading at a level that, once converted properly, implies a price close to $90 per ounce. Let that settle in. Nearly 90 here. This isn't a rumor, it isn't speculation, it is just arithmetic. Convert Shanghai futures into US dollars per ounce, and you find a premium of roughly $14 over the Western paper price. In global markets, a spread of this size is extraordinary. On a fungible metal, it borders on the impossible. Under normal conditions, this gap vanishes instantly. Arbitrage desks buy silver in New York at 75, ship it east, and sell near 90. The profit is risk-free. The spread closes in hours. The fact it hasn't says something is deeply wrong. The arbitrage mechanism is simply not functioning. When arbitrage breaks, it's not because opportunity vanished, it's because access did. Something prevents metal and money from flowing freely between these two markets. That blockage creates this distortion and creates opportunity for those who get it. Ask yourself which price is real. The one set by thin holiday trading and algos, or the one set by industrial buyers securing metal they actually need. Factories don't buy panic, they buy necessity. This spread doesn't signal the end of a rally, it signals stress. It is the market screaming that the paper price is detached from physical truth. And detachment like this never resolves gently. It resolves explosively. Why hasn't this $14 gap closed yet? Why is silver 75 in the West, while the East pays nearly 90? The answer is simple, but uncomfortable. The bridge between markets is broken. For arb to work, metal and capital must move freely both ways. That freedom is gone. New export rules will lock silver inside China, turning global flow into a one-way valve. You can move metal in, but getting it back out is a different matter entirely. For a Western bank, this is a nightmare scenario. Ship silver east to capture the price, and you risk getting paid in currency you can't convert. Worse, if the trade fails, you never recover the metal. That uncertainty turns easy profit into total risk. So desks freeze. When arbitrage freezes, prices are allowed to drift apart. That is exactly what we are seeing. The Western market has basically become an island. It's dominated by paper contracts, derivatives, and short-term bets. Prices here respond to sentiment charts and low-volume games. Meanwhile, the East is anchored in physical demand factories and long-term plans. This creates two realities. One price reflects fear and thin liquidity. The other reflects necessity and preparation. History shows how this ends. Paper markets can't dictate value forever. When physical demand tightens and supply can't respond, the paper price is forced to adjust, often suddenly and painfully. This divergence isn't weakness, it is pressure building beneath the surface. The wider the gap gets, the more violent the eventual correction will be, and right now that pressure is rising, not releasing. The question isn't whether prices reconnect. The question is how fast and at what level when they do. At this point, price action stops being about markets and starts being about psychology. If fundamentals are tightening, if the physical price is screaming higher, why smash silver to 75 now? Why do it during the quietest, thinnest week of the year? Because this is the moment fear is cheapest to manufacture. The days between Christmas and New Year's create a perfect psychological vacuum. Volume is low, attention is scattered. Retail traders are over-leveraged from chasing highs. Stop losses are stacked below the market. Here, a small push triggers a huge emotional response. That response is the real objective. Institutions aren't selling because silver is worth less. They're selling to buy more at your expense. By driving the price down during Ghost Week, they force liquidations. Margin calls fire, stops get hit. Weak hands are shaken loose. Who buys what gets dumped? The same entities that cause the move. This isn't theory. It's a recurring pattern. Markets are aggressive when participation is lowest because resistance is minimal. A move costing billions during normal volume can be executed for a fraction of the price in a holiday vacuum. This is why the drop feels personal. It attacks confidence, not logic. Doubt creeps in. Maybe the thesis is wrong. Maybe I should protect myself. That internal dialogue is the battlefield. Look at the timing. We are days from a structural shift that tightens supply further. Do you believe the smartest capital is panic selling days before that? Or are they using this window to accumulate while attention is elsewhere? This isn't a breakdown. It is a clearance event. The final shakeout before the rules change. We must talk about the calendar because timing is the silent force behind everything here. This isn't a vague outlook for next year or distant macro theory. This is a hard deadline measured in days, not months. January 1st changes the rules. New export licensing requirements turn silver from a free commodity into a controlled strategic resource. Bureaucracy replaces flow. Permissions replace markets. In systems like this, delays are measured in weeks, not hours. For January supply out of China, just freezes. That's why buyers in Asia are acting now. They aren't reacting to price, they're reacting to access. Every manager and procurement desk, Eichhorsack, knows metal secured today is guaranteed. Metal not secured may not arrive. This is insurance pricing, not speculation. That urgency is what you see embedded in the Eastern market. Meanwhile, the West plays holiday games, reacting to candles and indicators like nothing will change. This disconnect won't survive reality. On January 2nd, desks return, phones ring, inventory is reviewed, Western buyers find supply is gated, delayed, or gone. That is when price discovery actually begins. The $75 quote exists because demand is temporarily absent, not because value is. When real buyers return, they won't negotiate with fear. They'll compete with urgency, and urgency doesn't ask for discounts. This drop isn't the start of something ending. It's the pause before something irreversible begins. The countdown is almost over, and the market is about to wake up. When the market wakes up, it won't ease into awareness. It will lurch. Because when Western desks reopen, they are forced to reconcile two prices that should never have drifted this far apart. One reflects paper fear, the other reflects physical urgency. And that reconciliation won't be polite. On January 2nd, institutional money comes online. Portfolio rebalancing begins. Procurement managers re-enter. The first thing they'll notice is the spread. Silver priced cheaply in the West, expensively in the East. In a rational system, that gap is intolerable. So buying accelerates. Not because of optimism, but necessity. If you're an industrial user and see metal trading higher overseas while sitting artificially cheap at home, you don't hesitate. You secure supply. You stand for delivery. You drain the cheapest market first. That's how inventory disappears. As Western vaults thin, the paper price loses its anchor. Contracts that settled quietly now face delivery pressure. And when delivery pressure meets limited supply, repricing isn't gradual, it's explosive. This is why trading this environment is dangerous. Volatility won't respect logic. Swings will be violent. Algorithms hunt both sides. Anyone attempting to outsmart the move risks being shaken out just as the real repricing begins. The irony is brutal. The TAMP everyone wanted arrives and the majority are too frightened to act. Meanwhile, the entities with patience and capital are doing nothing flashy at all. They are accumulating quietly, letting time do the hard work. This is how paper illusions end. Not with a slow fade, but with a sudden snap back to physical reality. And when that snap happens, the price won't wait for your permission. It will gap up hard. What feels uncomfortable today is exactly what massive opportunity has always felt like before it becomes obvious. This is where everything aligns, and where veteran experience matters more than excitement. After decades of watching charts rise, fall, break, and reinvent themselves. One lesson remains constant. The biggest gains are never handed to the loudest traders. They are yielded to the most disciplined stackers. What you are seeing now is not chaos. It is a transition, a shift from paper-driven games to a physically constrained reality. The TAMP to 75 was not a verdict on silver's future. It was a test of resolve before repricing. A final attempt to transfer real wealth from the impatient to the prepared. The lesson here is simple but uncomfortable. These markets don't reward those who react fastest, they reward those who understand structure cycles and psychology. When fear is highest and headlines are loudest, the most important work is internal, staying rational while the herd panics. The true strategy in moments like this is rarely dramatic. It's patience. It's position sizing that lets you sleep at night. It's refusing to let short-term volatility override long-term reality. You don't need to predict every tick. You need to survive the noise long enough to benefit from the signal. Silver's story isn't about a single week or a single spot price. It is about scarcity, industrial demand, and a global system struggling to reconcile paper promises with physical limits. Those forces don't resolve quietly. They resolve decisively. If there's one takeaway, it's this: never confuse volatility with risk. Volatility is visible. Risk is structural. And right now, the structural risk isn't owning physical silver. It's not understanding why the market is trying so hard to scare you out of it. Stay grounded, stay curious, always stay disciplined. If this analysis helped you see the market more clearly, subscribe to the channel, like this video, and share it with someone who needs perspective right now. Please comment 1 if you're focused on strategy, not panic. This is where long-term thinking truly begins.